Very good evening, everyone. Am I audible? So the persons joined live, please answer. Am I audible? I will be waiting for 5 minutes. Let everyone join. And very good evening, everyone. Just 2-3 minutes. I will start. So I will tell you the learning objectives and how many classes I will be conducting, also everything. All the details I will tell you. Just 2 minutes. Because I am getting continuous messages. Sir, please wait for 5 minutes. We are also joining. So let's wait for 2-3 minutes. Let all the others also join. And hope everyone is preparing well for the exams. And I am really feeling privileged that I will be helpful for you at the last minute preparation with regard to the concept regarding the financial management and law. Continuously classes will be there with regard to this financial management and law. Details I will be giving you in another one day. Please inform your friends, ask them to join fast. Please tell your friends, ask them to join fast. Rohit Patil, sir, another 2 minutes. Please join fast. Yes, you can watch this video even after the live. I will be putting this. And definitely this session is not just reading and going session. The session will definitely add great value for your preparation, because I will be taking two chapters in one session. I will brush the entire concepts very fast. I will not take your more time. In the time available, I will cover each and every area. So it's a high time to start. So very good evening, everyone. Hope everyone is doing great. So this is CA Koushik Mukhesh, and we are here today for a revision or a concept discussion of CA Inter FM financial management in a different perspective. Not just like putting calculator, hitting numbers and making it. We are going to brush our entire concepts in such a way that any question that comes in examination, you will be doing your best in the examination with a lot of bravery and courage. You will face any kind of problem. Okay, that's a guarantee that I will give. And very, very good evening, everyone. Before we start, I will first make out what are the concepts that I am going to discuss today. Okay, please see here. When it comes to the marks coverage, there are 4 chapters which are core of the financial management. Chapter number 1, okay, cost of capital. Chapter number 2, capital budgeting. Chapter number 3, ratio analysis. Chapter number 4 will be dividends. These 4 areas, take any question paper, these will account for 30 marks of your paper. Okay, these areas will account for a good number of marks in your paper. And students also feel difficulty in understanding these concepts. So first what I am trying to do is, I will first explain you the concept, and again I am a strong believer of one saying, if you are perfect in concept, though a new problem comes, you will solve. If you are perfect in solving the problems, you are perfect only in that problem, and you are in a serious problem as well. So therefore, don't concentrate on number of problems. You do 1,000 problems, no doubt, no problem. But have the concept and do. The clarity will drive you to a right destination. Clear? So let us start with the concept. Let's go. So in this session, I am going to start with two topics. One is a dividends, another one is a cost of capital. If any small points of cost of capital remains, another session I will cover that in another half an hour or 45 minutes. First, let me first brush the concepts regarding the dividends, and then I will be going into the concept called as a cost of capital. Okay. So each and every point we are going to cover, not just overall analysis. Okay. So let us see what we are going to do. See the screen, everyone. I am taking the institute study material itself. I don't want to deviate from the institute standard. Let us take the study material and try to understand it clearly. See here, dividends chapter, there are totally following areas which you need to take care. Area number 1. First area, Walter model. Next area, Gordon model. Third area, Modigliani and Miller approach. Fourth area, Linter's approach. Okay. Fifth area, miscellaneous concepts. These are the various areas inside this particular chapter called as dividends. So in the dividend decision, these are the areas. 6 marks to 8 marks, damn sure in examination. We are going to cover these today, no doubt. First 1.5 hours I will be covering out everything. Then, sir, what we are going to do in this session, we are going to solve the problems. If it is solving the problems, you can sit in your study hall and you can do that. Okay, I will do the problems, but I will not create a problem. You should have a clarity in the concept. Intention is not to do the problems here. Intention is to understand the concept. People will put the book before them. They will see the problem. They will read the question. They will not understand anything. They will remember the formula. Okay, this number put here. This number put here. Calculate. You will do some outcome. Answer will come. You will see the book. Answer. Okay, done. Go to next question. Twist. Leave in exam. This situation we should overcome. Intention of the class is not to do the problems. What you have done till date, you have done the problems. Doing the problems is not the criteria. Understanding and doing is the criteria. Doing you can do, that understanding I will take care. Okay. So let me first explain you the concept behind every model. How the models have came, intention behind, such that just like that you will do the answers after the class. Take my word, now the time is 6:40 almost. Remember, my name is Koushik Mukhesh. After the class, you will see a paradigm shift in your understanding. Walter model means just like that you will do. Modigliani Miller. Most of the people, I want one reply from you. Everyone in the class tell me, whoever is listening now, do you know how the Modigliani formulas have derived? Idea behind Modigliani approach, not the problems. I am not talking about solution to the question. I am talking about if a new question comes, are you dare enough to answer Modigliani Miller? Because it came in the last attempt also for 8 marks. Are you perfect with the understanding of the concept? How the Modigliani Miller concept has come? I am openly asking you, first answer this. So that we are going to cover. Okay, answer is with you. To what extent we are losing the clarity? Sir, we have done problems, sir. We have done so many questions, but no clarity even then. So this thing will not be there after the class. That guarantee I will give. Let's stop the words. Let's start the actions now. Okay, first, why dividend chapter is there? First, let us understand that concept very quickly. Why dividends? Sir, why dividends chapter is there means, see here. Space is available, I will do here. See here. We are doing a subject called as financial management. Financial management. A person is purchasing a house. How to manage his finance? A person is paying taxes. How to manage the finance? This financial management we are not going to do. The word financial management of finance here represents economics related finance. Means what? I want to see the macroeconomic world of finance, not my home-made personal financing. I am getting a salary of 1 lakh per month. How to manage my finance? This is not the intention of the subject. I am going to manage macroeconomic finance. That's why attachment subject to this is economics for finance. The beauty of the institute is how they include the syllabus. It's not just a financial management and economics for finance. Theory was diverted towards that. Problematic part was kept in the part number A, 60 marks of financial management. Okay. So we are not going to just manage here. Okay. We are not going to manage personal finance. We are going to manage the macroeconomic finance. What is that? I will explain. Macroeconomic finance is something which is related to the market, which is not in my hand. Okay, I will give you 2-3 examples. Sir, every month I am getting a salary of 1 lakh. Example. At the end of the month, I could not save more than 10,000. How you can do? How you can manage now? I can tell. Give me the entire details of your expenses you are putting every month. On that basis, I will tell which cost you can reduce, which cost you can avoid, which cost you can cut to some extent. So I have taken groceries, etc., etc. So many things you have shown. I have shown instead of buying this, same quality you can go for alternative at a lesser cost. Like this, if you manage your finance, you can get your desired outcome. You can save 25,000 per month, I said. This is in your hands, which is controllable. Okay. Sir, groceries cost is becoming 30,000 every month. Reduce some groceries which are not so important for you. Automatically cost will reduce. So it is in your hand. But some economics is there which is not in your hand. That not in your hand when you manage, then only you become a chartered accountant. If everything is in your hand, normal grocery store person also can do that, means why chartered accountants? Chartered accountants are required to manage macroeconomic finance. Macroeconomic finance means stock markets. How to manage the stock market finance is the logic of our entire subject. Not only this, managing the finance of a company. Sir, what management of finance of a company? Listen. A company has to purchase a plant and machinery. A company has to purchase a plant and machinery. How the plant and machinery can be purchased by a company? How, what, on what basis? They followed a concept called as NPV. What is the concept they followed, sir? NPV concept they have followed. Okay. So how that is, capital budgeting lecture, I will explain that very clearly. So that is managing the finance of a particular company when it is going to make an investment decision. That is also one financial management. That means we are not doing any personal financial management, either company financial management or macroeconomical financial management we are going to do in this subject. Clear? And motto of financial management is, everyone know this, wealth maximization is the motto of entire financial management subject. So the entire intention of financial management is wealth maximization in the course of managing the finance. Okay. Now listen carefully to the point. We are jumping into the subject directly now. So first point number 1, we are not going to manage personal finance. We are going to manage the macroeconomic finance. Okay. Next, why dividends chapter? Question will arise. And why I started first with this? That question also will come. Listen carefully to the point. Whenever we are talking about financial management as a subject, it is all about valuation of a asset. Valuation of a asset. What is the value of an asset? Asset value is present value of future cash flows discounted at required rate. This is called as a value of asset. If I tell like this, no one will understand. I will give you an example. Everyone listening to the class, don't listen to this session like a harikatha. First point number 1, put book with you, a calculator. 2 very important things that are required. Feel that we are really sitting in a class and listening to the lecture. Okay. So don't listen like a harikatha or something like that. So please be serious when you are learning. Put a calculator and a white book, whatever the book you are using. I will ask you some workings, do and put as a comment. I want everyone, please participate and respect towards the subject, if not towards me. Please respect the subject. Am I clear, everyone? So please respect the subject and let us concentrate properly. 2.5 hours session means 2.5 hours we should concentrate. Clear? At the end of the session, as I promised you already, your thinking concept will change on dividends chapter. That is a guarantee I will give you. Hope everyone is ready with a pen, a book and a calculator. Please put a yes message. Everyone. 1 yes. Okay. Thank you. Okay. Let us start with the concept now. So, before we go into the concept, first I will explain you one point. Listen carefully. Value of an asset is the present value of a future cash flow discounted at a required rate of return. Okay. Listen carefully. Present value of future cash flows. Sir, why future cash flow, sir? Why future cash flow? Listen, investment in a share will be always made not on the basis of its past results. Past results is only a motivation to know about company. But investment will be made not on the basis of the past, will be on the basis of what it gives me in the future. I will give you 2 examples. One from a real life scenario, another from the concept on the capital budgeting. Listen carefully, focus. I want to invest in Kingfisher Company Airlines shares. Okay? Kingfisher Airlines shares. I want to invest. Now everyone put a message. Will you suggest me to buy that? Answer. Participation. Participation, everyone. I want to buy the shares of Kingfisher Airlines. Will you suggest me to buy? As a normal person, you know how Kingfisher is today. On that basis, will you suggest me to buy? Yes. Obvious answer from almost every participant. Everyone is answering only one common thing. No, 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 no and no. And my answer is also no. My answer is also no. Dharmendra Singh Rajpurohit, never. Okay. So the point is, you will never suggest it. Okay. Now if you listen, past performance of Kingfisher Airlines, if you take 8-9 years back now, one of the best companies in airline industry. Do you know that? Now tell me, On the basis of past, if you go and make investment in Kingfisher, you are gone. You are died. That's all. You will die. For sure you will die. If you invest in Kingfisher Airlines shares on the basis of its past performance, you are going to die. So why? Past is fantastic for it, but the future is a waste of time. Vijay Mallya ran out of the India means who is there to control the company, and the company is already insolvent and bankrupt. So I don't want to invest in the shares of Kingfisher because its future is not promising. It has cash flow but not future cash flow. Am I clear or not? That means when I invest something, I want something from that asset in the future. After my investment, what it gave is important to me, not what it gave already to the previous owners is not important to me. Do you understand the language I use now? It is not important to me as what it has given to the past holders. I will invest money. What it will give to me is important for me. What it has given to the previous owner. Why I will be concerned about the previous owner? So therefore, investment should be made always on the basis of future, not present. It's always future. Okay? Accountancy depends on historic cost, past. Already happened events, you will write journal entry. But SFM or FM is not like that. It is on a futuristic basis. We will predict the future. Okay. So this is the main important point that you have to understand. Okay. I will go into the point again. Value of an asset is present value of future cash flows discounted at a required rate. Now 3 points we have to understand. Okay. 3 points we have to understand. Okay, see here. To value any asset, a triangle has to be answered. Okay. First thing, what is the value of an asset? It is a combination of 3 things. Number 1, life. Number 2, future cash flows it is going to give us. Number 3, discounting factor. Discounting factor. KD, KO, KE, like that we will do the discounting factor. Okay. Now listen. Asset can be of 3 types. Asset type 1, real asset. Land and building, plant and machinery, all these will come under real assets. Land and building like that. Okay. Next. Financial assets being shares. Financial assets being bonds, also called as debentures. Life of a land and building. Land and building, exactly we can't tell the life, but we can estimate to the least approximation we can estimate. Means what? Best estimate we can make. Because a building can't be expected to live for more than 50-60 years. Because after 50 years or 60 years it requires a renovation. Huge renovation means it is almost a new building again. So the essence of this building will be lost in 50-60 years, I can tell like that. So approximately it is nearing. I can estimate life. Okay. Building means 50 years, 40 years, 60 years. Type of construction will decide the life. Bonds and debentures. 100% surely I can tell, because bond when it is issued itself, they will give a life of the bond. Okay. Fixed. Shares. The dangerous thing in the world. Share, we can't estimate the life. Why? Company law will say already, always a company will have a perpetual succession. Means what? Shares are transferred from one person to another person. How many times? Infinite times it will transfer. That means share will be there till a company is there. company will be there till perpetual succession, means company will be there for infinite period, share will also be there for indefinite period, life unknown. Life unknown. Next, so 3 things. Bond, fixed life, land and building approximated to perfection, shares unknown. Okay, share is difficult here. Okay, next, what is the future cash flow? Again same, real asset, shares, bonds. Land and building, plant and machinery will give rent. So rent is sure, not sure, definitely rent will come. Anyway, you will only fix the rent, so you know how much is the rent. So it is a fixed income. Bonds will give interest. This is also a fixed income. Why? At the time of giving the debenture itself, they will tell 10%, 5%, 8%, 12%. They will give the rate. So it is fixed already. Share, dividends. It is a fixed variable. It is a variable. Technically, to be very clear, God should know whether company will declare or not. No one will know. Even board of directors also don't know till the year end. Depending on the profits only, they have to declare. Depending on the investment opportunities, they have to take a decision. Then how can they tell by giving a guarantee? Koushik Mukhesh, you purchase shares of my company, definitely we will give you 3 rupee dividend per share every year. How can they give a guarantee like that? They cannot. So again, share is very, very difficult because we can't estimate whether dividend will be paid or not. Risk is there or not? Yes. Discounting factor. If I issue debentures, shares, land and building. Okay. Now listen carefully to the point. my company issued debentures. Debenture holders, when they give me the debentures, they will expect something in return or not. That's called as a cost of debt. That's called as cost of debt. Shareholders also will expect some return or not. That's called as cost of equity. Cost of equity. Land and building. Listen, this is very important. So land and building, plant and machinery, all these things. Company is purchasing a land and building out of its own funds. Then required return will be KE, because you are using only your company's existing equity. No sir, we are using 30% debt, 70% equity. Then it is KO. It is what sir? KO. Okay. So how to calculate this KE? Very, very difficult. On this CA final will take care how to calculate KE. CA interval just we will discuss KE in 2 ways. KE equal to D1 by P0 plus G, one model. KE equal to RF plus beta into RM minus RF, second model. But how these came, there is a separate chapter with 80 problems inside in CA final. There we will literally tear the chapter. The name of the chapter is called as Portfolio Theories and Asset Pricing Models. CA final we will discuss about that. At this level of CA inter, we should know only how calculation of KE will be. But there also I will tell you the conceptual discussion. Okay, not so lengthy, but I will explain in an easy way for the CA inter students. Okay, so now you have to observe clearly. If the asset here is a share, what is the value of a share? Value of a share depends on 3 things. Life of a share, dividends on the share, discounting factor on the share. Discounting factor on the share. So to value a share, 3 things are required. Okay. Number 1 is its life. Life anyway unknown, perpetual succession. Okay. Dividends is first part. Second one is a KE. 2 things are required. This dividends is discussed in dividend decisions chapter. This KE is discussed in cost of capital chapter. These 2 only I am trying to discuss in this session. I think first 30 minutes I revealed what I am going to do. Now you have to give your reply. Everyone. Hope you are now understanding. Okay. Now, we are now going to understand how this chapter will go on. So, whenever I talk about dividends, okay, dividends will impact, share price or not. If any person asks you, first answer is it is necessarily yes and yes. Dividends will necessarily affect the share prices. Yes. If you declare dividend, one share price will come. If you don't declare dividend, another share price will come. Okay. But whether wealth changes or not is a question. Whether what changes, sir? Wealth changes or not is a question. Listen, this thin line difference between share price and wealth itself is what we discuss in Modigliani-Miller approach. Okay, in what approach, sir? Modigliani-Miller approach. I will first discuss about difficult concept. Later I will come to easy areas like Walter Garden, etc. Okay, so let me first put my discussion on Modigliani-Miller. I want every one of you open your books. Pen, calculator. 3 things are required. We are now jumping into the main area. Please, everyone. Okay, we will take Modigliani-Miller question also, latest question. Latest question also we will take and we will do. First, even before we go into that, I will give you one simple model of how Modigliani-Miller approach has come. Let us do together. Write down. approach, logic and understanding. Approach, logic and understanding. Approach, logic and understanding. And whoever are the concurrent viewers in the class now, whoever is now attending the live and listening, listen directly. After the stream is completed, you will never listen. Now or never. Listen now. Sir, completed. Later it will be useful for you as a revision, or else again you have to sit for 2.5 hours to learn the class. In live way, completed. Okay, that's ideal always. We spend so much time to watch movie now. Please spend time for you. Okay, spend time for you, spend time for your career, spend time for your future cash flows. Okay. Modigliani-Miller approach. Write down. Balance sheet. Liabilities, amount. Assets, amount. Liabilities, amount. Assets, amount. Okay. Now, fixed assets 9,000, cash 1,000. Liabilities, equity, simplify model only. I am not going to complicate the balance sheet. 1,000 shares of ₹10 each, 10,000. This is a simple balance sheet. This balance sheet, what you are seeing on the screen, is not a balance sheet that I have taken. Modigliani-Miller has got a Nobel Award for the field of economics for his best invention of, when he founded the concept called as, Modigliani-Miller has found out three concepts totally. Number 1, dividends irrelevance. We are going to see now. Capital structure theory, primary arbitrage and secondary arbitrage on capital assets. Second model. Third one is a general market theory, traditional approach by Modigliani-Miller. Okay. In this third one is not in our syllabus. First 2 are in our syllabus. Okay. One will be discussed in capital structure theories. First one will be discussed here itself today. For those 3 models, he was given with the prestigious Nobel Award. Noble award means one from every 10 crores we will get. 1 in every 10 crores means you can imagine how great they are. When they started proving the model, he has taken this as an example. He has taken dollars. For the sake of understanding, I am taking rupees. That's all. Mera Bharat Mahan. Okay, just for the change and because of that motherly affection towards India, I am taking rupees. Okay, but really the model has taken dollar 10,000 to dollar 9,000 to dollar 1,000. He has taken the same balance sheet which you are seeing on the screen now. Whatever you are seeing on the screen, it is not a balance sheet taken by Koushik Mukhesh. This is the balance sheet taken by Modiglaney Miller. Really, why he got a Nobel Award? Sir, for this balance sheet Nobel Award, didn't come. Balance sheet don't get Nobel Award. What is there in here? Okay, you also can do this. Based on this, he prepared the model. Hats off. So how he has done, in my words, I will explain. Start, camera, action. See here. From here, no need to write. I will first explain. After that, you can write. Okay? Now listen carefully. Every company will have three kinds of activities. Operating activity, investment activity, financing activity. Operating activity, investing activity, financing activity. Cash flow statement also will see these three variants. Okay, na? In the cash flow statement also you will see the three variants. One is operating activity, another one is investing activity, and third one is a financing activity. Recently I am having continuous classes back to back in Chennai. Okay, because of this throat pain. But by the way, thanks to KS Academy Lifetime for giving best experiences as a teacher. I am very thankful to KS Academy always. So, let us start. First one, operating activity, investing activity, and financing activity. These are the three kinds of activities every company will have. Modiglaney Miller says that operating activity, you may be in pharma business, you may be in for example, you may be in entertainment business, you may be in infrastructure business, you may be in automobiles, you may be in software, whatever may be your operations, really that doesn't matter. Wealth of the company is not affected by the operations you choose. Every operating activity or every operation will have its own advantages and disadvantages. Software, what is advantage? Software is an intangible asset where value we can't calculate directly. That's a difficulty of software industry. But what is the advantage? Software is always having a right boom in the market. Okay, technology not there, nothing can be done in the today's life. Pharma, I need not tell the medical sector, it has its own advantages and disadvantages. Okay, entertainment, infrastructure, automobile, every industry will have its own advantage, disadvantage. So I can't tell this is the only industry which is correct, then everyone will start only that. Why these many industries will come? So therefore, whether you start software, pharma, entertainment, infra, automobile, power generation, utility sector, you do whatever you want. Really that doesn't care. If you do good, your wealth will always be good. So this is irrelevant in deciding the wealth, because if I take software, wealth will be there. If I take pharma, wealth will be there. Means it is about how you do the operations, that's all. Okay, financing. whether you finance your investments by equity, debt, combination of equity, debt, it doesn't really impact your decision making. Okay, really financing is irrelevant. Whether you finance by equity, whether you finance by debt, that really doesn't matter. It doesn't show any great impact on the wealth. Wealth will always remain the same. whether you finance by equity, whether you finance by debt. So how to prove that? This is discussed in Capital Structure Theories chapter in a concept called as a primary and secondary arbitrage. Okay, there we will understand that when I come there. Investing activity, very, very important. Modigliani Miller says that you do any operation activity, you do whatever mode of financing you do, wealth will always remain unchanged if you do it good. But what will really decide? Investment activities are very, very important for a business. If you have good investment activity, investment opportunity, repetition once again, if you have a good investment opportunity, whether you finance by equity, whether you finance by way of debt, wealth of the company will not change. Okay, that means try to understand, wealth of the company is not dependent on the operating activities, not on the financing activities, but how you are going to invest your funds. Investing decision is very important. If you have a good investment opportunity, then your company wealth will always maximize. So what is the objective of financial management? Wealth maximization. That is not possible because of operations. That is not possible because of financing. That's because of good investment activity or good investment opportunity. Sir, why you kept good in quotations? There is a meaning also for that good. At the last I will discuss about that. Okay. So we are now going slowly into the concept. Okay. We are now slowly going into the area. Let us try to understand clearly to the point. Okay. See here now. So whether you have operating activity, whether you have financing activity, really that doesn't matter. What matters is your investment activity. Listen, from this balance sheet we are going to analyze. Okay, see here now. Fixed assets 9,000, cash 1,000, equity 10,000. Listen. Modigliani Miller want to tell that you may declare dividend, you may not declare the dividend, wealth will not change. You may finance using equity, you may finance using debt, wealth will not change. You may take software, pharma, infra, wealth doesn't change. Then what will impact the wealth? Investments will impact. You have good investment opportunities, wealth will increase. You have bad investments, wealth will fall. How? This is what we are going to prove now. Okay? So, dividend is not what impacts, investment is what it will impact. That we are going to analyze and do in this particular session. Next 45 minutes, observe only the screen. Listen, focus totally. Okay, your intentions and ideology behind this chapter will change. See here now. How it has to be understood. So, this is a balance sheet. This company is having investment opportunity of rupees 1,000. Take 1,000 crores or 1,000 lakhs, whatever you want. I am writing for simplicity's sake 1,000. Investment opportunity of 1,000 rupees is there. Now listen carefully. In my company, fixed assets are 9,000, cash is 1,000, equity is 10,000. Investment opportunity 1,000 is there. I want to put investment of 1,000. From where I will get this 1,000? Okay, two questions will arise. Dividend declared, dividend not declared. Dividend declared, dividend not declared. First I will answer dividend not declared. If dividend is not declared, what I will do? This cash of 1,000 I will utilize for investment. Automatically cash will vanish in my balance sheet. 9,000 fixed asset will become 10,000 fixed asset. repetition. See the screen. I am going back. There is a company. This company has an investment opportunity of 1,000. Two situations may arise. At the end of the year, I have opportunity. At the end of the year, I have a opportunity. Cash of 1,000 is available. Now I can do two things. I can use this cash, invest in that investment, make the fixed assets as 10,000. That's one opportunity available. And that is possible if you don't declare dividend. If you don't declare what's a dividend. Okay, now see the point there. Dividend not declared. If I don't declare the dividend, what will happen? Cash becomes fixed asset. Cash becomes what's a fixed asset. Simply in your language, shall I tell you? Fixed assets account that are to cash. 1,000. What will happen? Cash credited means after this, my balance sheet look like this. Fixed assets 10,000. Cash will be 0. Equity will remain same at 10,000. Automatically what will happen? Wealth is 10,000 only. So before declaring the dividend, value of the company is 10,000. Even if I don't declare the dividend, equity value stands at same 10,000. So if you don't declare the dividend, price of a share is changing or not changing? Not changing. Technically, the total wealth is changing or not changing? Not changing. This is a point number 1. Hope everyone understood the point up to here. First, I want one. Yes, we completed 20% of Modigliani theory. Like this in parts, I will complete. Everyone, one answer. Understood or not? Understood everyone? Okay. Next issue. So if you don't declare dividend, whether don't declare dividend or existing position 10,000 wealth, you declare dividend 10,000 wealth. Okay, you don't declare dividend 10,000 wealth. It is not changing. Now let us see what happens if dividend declared. Before explaining this, I have to first explain you the concept of cum dividend and ex dividend. What is the concept, sir? Cum dividend and ex dividend. What is this concept of cum dividend and ex dividend? I will explain you first. After that, we will understand. Okay, see here. There is a person. He went to the cattle market. Cattle, live cattle. Buffaloes, cows will be sold, na? Veterinary. So that style. So animal husbandry department will take care. Sale of cattle. So a person took a cow. Cow mela is getting conducted. You can buy at a cheaper cost. It will be conducted in villages. Animal husbandry department will do that. So cows are getting sold. People will pay cash and they will take the delivery of that live cattle. Listen, a person went to another person. He said, I want this cow. He said 80,000. Arey, why 80,000 here? Only 55,000 everyone is selling. I am trying for 50 bargain. Why you are telling suddenly 80? How it come 80 is possible? Is it a different breed or what? I know that it is a normal breed only. Why 80,000? Immediately the other person answered, sir, this is not a normal cow. This is having a calf inside it. In another 1 month the delivery will happen. That means you are getting a double benefit or not? Why I have to give the double benefit free of cost to you? So, if you have to buy after its birth, double cost you need to spend, 50-50 you need to spend. I am telling I will give you at 80,000. Other person thought, really, if I buy the cow now, I will not only just get the cow, along with the cow I will also get a calf in another 1 month. Maybe if it is a female cow, I can use it for milk, etc. If it is a male cow, I can use it for agriculture. Both ways it is advantage for me. Okay, he said, sir, okay, I will buy. 80,000 he purchased. Hope you can understand now. Okay, 80,000 he purchased. After that, after purchasing that cow, really calf came out. Either a female cow or a male cow, that is irrelevant here. Both are greatly useful for agriculture. One for the milking purpose, it will be useful. So both sides he is having a great advantage. Calf came out. Now again he want to sell this cow, main cow, and he want to buy another. Again he went to the mela after 1 year. He said, I want to sell this cow. Another person came to him. He asked how much. Again the person said 80,000. Other person asked him the same question. Why 80,000? Everyone is selling at 50,000. He said that it is not a normal cow. Other person said it is a normal cow only. There is no calf inside. So don't include the calf cost into that. Tell me without that. He said, okay, pay 50,000 or 45, 50,000. He sold. Why the cow cost is not 80,000? Because calf has come out. Once the calf comes out, asset value, the cow value will not be same. It is a reduced value. Same happens also in case of shares. Share will have two prices. Cum dividend, ex dividend. Cum dividend means including dividend. Ex dividend means excluding dividend. Okay. So that is a cum calf cow, 80,000. Ex calf cow, 50,000. Like that cum dividend share price is 10 rupees there. Ex dividend share price, the dividend amount will reduce. There, calf cost will remove. 80,000 minus 30,000 will become 50. Here, share price is 10, which is loaded with the dividend. Once the dividend is declared, the share price is no more 10, it will be less than 10. Hope everyone understood now. Yes, sir. Up to here, everyone had clarity, yeah? Okay. Now, listen carefully. How much I can declare? I have a cash of 1,000. 5,000 dividend I will declare. 1,000 means 1,000 only maximum I can declare dividend. So, dividend declared. Amount available rupees 1,000. Number of shares 1,000. Dividend per share rupees 1. Dividend per share rupees 1. Now, what will happen? Market price per share before dividend rupees 10. Before dividend rupees 10. Okay. Market price per share. Listen, this is complicated issue. Please listen carefully, not that easy. MPS before declaration 10 rupees minus dividend came out, calf came out, remove 1 rupee, ex dividend share price equal to rupees 9. Now 10,000 value worth company suddenly became 9,000 worth company. Yes or no? So I repeat, dividend is declared, bubble busted. 10,000 company la 1,000 rupees went off. Assets side la cash went out, liability side la equity gone. Okay. So suddenly 10,000 company has become 9,000 company, wealth has reduced. Sir, you said whether you declare dividend, don't declare dividend, wealth doesn't change. Where, sir, it is changing now? No, listen, don't celebrate early. I didn't complete my discussion. So, ex dividend share price is rupees 9. Ex dividend share price is rupees 9. Clear up to here? Now listen to the story. Investment opportunity from where you will get. Cash 1,000 went off in the form of dividend. I have an investment opportunity, must and should I should keep. From where I will get? I will go for public issue. I will go for public issue. For 1,000 rupees public issue will not be made. 1,000 crores public issue we made. 1,000 means 1,000 crores. Let's try to understand like that. Okay. Now I want to make 1,000 rupees public issue. Now listen. First answer this question. We are going for public issue. Listen. We are going for public issue after investment. Before investment. Before declaring dividend. I will repeat my question. I'm very sorry. I made it a wrong question. I will repeat once again. We are making investment of 1,000 After declaring dividend, before declaring dividend, first put this answer. From that I will start my discussion. Participation, everyone. Don't sit idle. Participation. It's a high time for you. Exams are nearing you. Fantastic, everyone. Very good. So we declared dividend already. After declaring dividend, we are going for public issue. Okay. Now listen. Price of a share which is 10 is now fall to 9. Share price reduced. Okay. Not wealth. Wealth is different. Share price is different. Let us see how it will happen. So the point is, we have share price traded at 9 rupee. Now listen carefully to the point. How much investment opportunity is there? 1000. How much, sir? 1000. I want to go for public issue. I want to issue shares to the public. At that time, what is the market price per share? Rupees 9. Means how many number of shares I have to issue? Take calculator. Everyone, don't sit idle. 1000 divided by 9. How much? How many shares? 1000 divided by 9. How many shares? Uh, 111. So it is 111 shares. How many shares, sir? 111 shares. Sir, 111 shares rounded to the before number because it is not 0.5 more. So 111.1111 something we got now. Let us fraction it and close it to the decimal before that. 111 shares we will issue. So total number of shares will be, already we are having 1000 and we added 111 shares. How much it became? 1 shares. 111 shares. Now tell me how the balance sheet will look like. Already fixed assets 9000 is there. New investment opportunity through public issue we have made. So that investment has been another 1000 rupees. Now the equity we are having 1 into 9, 9999.9999 something we will get now. It will be again equal to 10,000. Wealth again remain the same. Share price may reduce from 10 to 9, but overall wealth is maintained at 10,000 again. So whether you don't declare dividend or whether you declare the dividend, really wealth does not change. Objective of financial management is wealth. Wealth doesn't change in both the cases. You don't declare dividend, wealth 10,000. You declare dividend, wealth 10,000. This is because of whom? Because you maintained your investment opportunity. You maintained your investment opportunity. That's what you want to convey. If a company is having a good investment opportunity, whether you declare dividend, whether you don't declare dividend, wealth of the company will not change. This is the objective of Modigliani Miller. Up to here, everyone understood? 50% of the concept we completed now. Okay. Okay, very good. So now we completed 50% of the concept. Yes, we are done. Next one. So once we complete this 50%, Hope everyone is having full length clarity up to here. Okay, just I'm giving you 1 minute time. Review the entire concept very fast. Hope you completed. Let me continue my discussion now. Hope everyone reviewed the entire answer up to here. Okay, now let us continue with the concept. Next. So the concept discusses on dividend decisions is a chapter name. In that chapter, why Modigliani concept is there? This is called as a irrelevance theory. Theory is not irrelevant. It says that dividend decision is irrelevant. Whether you declare a dividend, whether you don't declare a dividend, wealth of the company will not change. This is a proof. On this basis, he formulated a formula. Okay. First, listen carefully to the logic. Everyone in the class, please listen. Listening is important. Now we are going into the formula and the approach. Okay, we are going into what's a formula and approach with regard to this particular area. Let us start with the approach of the formula. See here. Modigliani Miller formulated 3 formulae. Formula number 1. This is called as single period pricing. Single period pricing. Single period pricing. Number 2, amount to be raised by new issue. Now public issue we have seen na same concept. Third one will be wealth of company. 3 different formulae he found out. One by one I will explain you the logic. First, single period pricing. Okay, value of a share is what? Value of a share is today's value. Value of a share is present value of future dividends and future price discounted at a required rate. Sir, I didn't understand. I will explain this way. Price of a share today equal to price of a share today depends on the past dividends of future dividend. I call it D1. After 1 year, I will sell the share at P0 or P1. P1. So I will pay P0 on the basis of 2 things. Number 1, D1 plus P1. D1 means dividend after 1 year. P1 means price after 1 year. Means what? I will purchase a share today, take dividend after 1 year and sell the share at P1 Listen to the logic very clearly. Once again I am repeating, this is itself is important. D1 plus P1 la magic is there. The magic of understanding. See here. I will purchase a share today at P0. Today's price is called as a P0. Why you will purchase? Because I am expecting D1 dividend. After taking the dividend, I will sell the share. After taking the dividend, I will sell the share. Once I sell the share at P1, I will get a P1 cash flow. So two cash flows I am going to get. One is a D1, another one is a P1. From that D1, P1, you should understand one logic. D1, dividend after 1 year. I will take dividend and then sell. Means I am going to sell at X dividend price. At X dividend price. I am not selling at cum dividend price. I am selling at a X dividend price. Why it is X dividend price? Array, you are taking dividend and selling. When you are taking dividend and selling it, again dividend element will not be there inside. That's called as a X dividend share price. Hope everyone understood why I discussed about X dividend in the previous concept. Hope everyone at least now understood why I am discussing so much about X dividend in the previous issue. Okay. So the model says that, okay, the model suggests that he will invest, a person will invest at P0 for two reasons. He will expect two different cash flows. One is a D1, another one is a P1. But I want present value of future cash flow. This is a future, this is future. But I want present value. Therefore, divided by 1 plus KE. This is one formula. So tell me, P0 equal to D1 plus P1 divided by 1 plus KE. Hope everyone understood the point up to here. First formula. This is called as a single period pricing formula. 1S. 1S everyone. Please, users and viewers, don't leave live all of a sudden. If you cut the concept, na gone. Everyone understood to here. So, P0 equal to D1 plus P1 divided by 1 plus KE. Hope everyone understood the logic of this. Okay. Next. First formula over. Second. Amount to be raised. Amount to be raised. Okay. Amount to be raised by new issue. Listen, this is more complicated. Listen carefully. Amount to be raised. Listen carefully. Amount to be raised. First, you have investment opportunity. Yes. How you are going to cater this investment opportunity? I am going to invest using two sources. Existing retained earnings, and next one, if not sufficient, I will go for public issue. Listen carefully how the formula has come. I will explain. I have investment opportunity of I. I have a investment opportunity of I. Everyone listen carefully. I am going to raise money after paying dividend or before paying dividend. First answer this question. Again I am asking. After, before. That's all. Only two answers you need to give. After, before. Everyone. Very good. Very good. Very good. Everyone. Everyone is listening. Okay. After declaring the dividend, you are going to pay. Okay. After declaring the dividend, dividend will be paid at the beginning of the year, ending of the year. Question number 2. Answer. Beginning of the year, ending of the year. Dividend will be declared at the beginning of the year, ending of the year. Beginning, end. Only two answers. Very good. Dividend will be declared at the ending of the year, not at the beginning. Let the financial results come. After that, we will pay the dividend. Okay? Okay, very good. Thank you. Thank you very much. So, dividend will be paid at the end of the year. Dividend will be paid when, sir? At the end of the year. Okay. Now, at the end of the year, after declaring dividend, I repeat, after declaring dividend, then I will go for public issue. Means you only said dividend will be declared at the end of the year. Means that will be D1. That will be what's a D1. Okay. Now, I am going to raise money by public issue after dividend. When D1 is there, I will declare at what rate? I will raise money at P1 rate. In our example, I will not raise at P0 of 10. I will raise the public issue at 9 rupee of P1. Okay? P1 is 1 share price. How many shares you are going to issue like that? M number of shares. That M can be 10,000 or 20,000 some number. Okay? Means amount to be raised is called as MP1 is called as what? MP1 is called as amount to be raised by new issue. Listen, complication will come. Listen first, later you can copy. MP1, number of shares to be issued per share value after declaring dividend equal to this amount. What you will use? This amount you will use for investment. That means investment will be made out of MP1. Investment entire. Sir, I want 10 lakh for investment. 10 lakh you will raise new investment. May not be. From this investment, how much you will use from the existing resources? Minus earnings of the company minus number of shares before public issue into dividend declared at the end of the year. How to understand this? Total I have 100 rupees. Total I have 100 rupees. In that 100, there are 10 shares with me. 5 rupee dividend I declare. N into D1. Earning is 100 minus 50. How much is the balance? 50 rupees is the balance. Clear? So this is called as a retained earnings. This is called as what's a retained earnings. Okay. How much investment opportunity you have? 150 rupees investment opportunity you have. In this 150, entire 150 you will go by public issue or no? In this 150, 50 I will use my resources. 100 balance is there na? That only I will go by MP1, new issue. Okay. So now how to understand? I minus E minus ND1. This is called as formula for MP1. First, everyone should tell me understood the logic of the formula or not. Not writing the formula mechanically. Understood or not? First, tell me that. Okay, thank you. So let us again move back to the concept. Okay, so this is second formula. This is the formula I said, amount to be raised by new issue. Second formula also we understood. Now wealth of the company. Listen, I will write here. Wealth of company. Already I said you one formula. P0 equal to D1 plus P1 divided by 1 plus KE. Now what I will do is, I will multiply LHS and RHS by N. How it look like? NP0 equal to ND1 plus NP1 whole divided by 1 plus KE. So numerators I multiplied by N. P0 divided by 1 it is there. Okay, numerators only I am multiplying. I am multiplying by what? N. NP0 equal to ND1 plus NP1 whole divided by 1 plus KE. Up to here everyone understood. Okay, now NP0 equal to P0 means per share value, today's value. N means what? Existing number of shares, means existing wealth. NP0 means existing wealth. ND1 plus NP1, what I will do is, I will add MP1, I will deduct MP1. Answer will change, will not change. So I will add 2 and deduct 2. Answer will change. I will add 2 and deduct 2. Answer will change. Will not change. Like that I will add MP1, deduct MP1. But there is the answer will not change, but the impact will totally change now. NP0 equal to ND1 plus NP1 plus, already see here. MP1 we have written a formula here. I am writing also here once again. MP1 equal to I minus E minus ND1. So MP1 ND1 plus NP1 plus MP1. I will write that now. Okay, I will write that. So plus MP1 minus I minus E minus ND1 whole divided by 1 plus KE. What I have done? ND1 plus NP1 plus MP1 minus MP1 I have done. ND1 plus NP1 plus MP1 minus I minus of minus E plus E minus of minus ND1 whole divided by 1 plus KE. NP0 equal to, okay, NP0 equal to minus ND1 plus ND1 cancel each other. NP1 plus MP1 minus I plus E whole divided by 1 plus KE. NP0 equal to P1 common, N plus M minus I plus E whole divided by 1 plus KE. This is how the formula has been derived. Hope everyone would have understood what I have done. Everyone, all the participants and the viewers, please give a reply, understood or not. Now, 2 questions I will ask you, answer these 2. Okay, 2 genuine answers. Number 1, everyone listening know these 3 formulas previously or not? Tell me. Everyone listening to the class know already these 3 formulae? Yes, everyone will know. Did you know the logic of how they came? Did you know logic of how they came? Like this. That's what I am trying to explain. My only intention is, that's why I kept concept discussion, not problem discussion. Concept if I discuss properly, okay, concept if you understand properly, any problem it come, we will do problem now. We will do one problem. A comprehensive problem we will do from the study material A. Okay, so we will do one problem directly. At that time you can really understand to what extent this explanation has helped you. Okay, so let us try to understand clearly, try to make out some sense out of the problem. Okay, so hope everyone understood what is the concept of Modigliani-Miller. Okay, now we are going to analyze problems with regard to the Modigliani-Miller now. Okay, without declaring dividend, with the declaring dividend, we are going to do one comprehensive problem. If you do that question, you need not do other questions in Modigliani-Miller. Happily sleep, directly examination hall target. Okay, so no problem. In with regard to that particular Modi Miller. Just a minute. Okay. Let us take one question. Okay, he has given one question here. Let us take this. Illustration 11. Illustration 11. Everyone get ready with the calculators, get ready with the pen, get ready with the book. We are going to solve one question. Miscellaneous illustration 11. RST Limited has a capital of rupees 10 lakh in equity shares of rupees 100. The shares are currently quoted at par, means MPS itself is 100. The company proposes to declare a dividend of rupees 10 per share at the end of current financial year. So it is D1 na D0 na D1 at the end of current financial year. The capitalization rate means KE for the current risk class belongs to 12%. Compute the market price of the share at the end of the year if dividend is not declared, if the dividend is declared. Don't see the answer. Sir, we are now doing our analysis. Okay. So therefore no cheating, nothing, because if you cheat, you are cheating yourself, that's all. You are not cheating anyone. Read the question only. Don't do any other thing. Okay. Read the question properly. After reading the question, we will go into analysis. Just I will give you 1 minute time. Read the question properly. Participants, please sit here, listen and complete. Don't put a concept of listening later. If my mindset is very bad, I will delete the video. So please, complete in live. I am giving you 1 minute time, everyone. Read the question properly first. Hope you completed reading. Everyone, enough time taken. So let's continue. Let's continue. So let us do together now. Take your pens, everyone, please. Let's solve. First, he is asking, compute the market price per share at the end of the year if dividend is not declared. We understood the formula now. P naught equal to D1 plus P1 divided by 1 plus KE. Logic also we understood. Value of a share today depends on future cash flow discount at a required rate. So future cash flows mean D1 and P1. As simple as that. So if dividend is not declared, D1 will be 0. P naught already we know 100. Already given in the question 100. Plus P1 divided by KE 12. 1.12. So P1 equal to 112. If the dividend is declared or not declared, not declared. So if the dividend is not declared, price is 112. Price is 112. Okay. Now, next issue. Dividend is declared. Now, first, before you do, I want one answer from your side. Before you do, I want one answer from your side. It will be more than 112 less than 112? It will be more than 112 less than 112. Shall I tell you the answer directly? How much dividend you declare, that will be reduced from the price before declaring dividend. Means 112 minus 10 will be the answer. Why? Array X dividend, cum dividend concept I said you na. Total price minus dividend, X dividend. You need not even do the formula. First, let us first understand the concept. Concept if you have na, in fingertips you can do FM. Even SFM for that case. Okay. So, directly you can tell the answer. Cum dividend is 112 before dividend minus 10 rupees is the dividend that is declared per share. So, 112 minus 10 is 102, answer over. For that you need not even use a calculator. But still, examiner will expect us to use the formula we are writing. P naught 100 equal to D1 plus P1 divided by 1 plus KE. Clear everyone? So therefore, D1 is this one. 1 plus KE will become 1.12. So 112 equal to 10 plus P1. P1 will be X dividend price. Therefore, we need to reduce the dividend now. 112 minus 10 equal to P1. P1 equal to 102. So the answer is 102 in this case. Hope everyone understood up to here. Okay. So, two answers we have obtained. Now, let us apply our skill. Skill is given only if you understand the concept. I am not telling apply your mind. Mind remember everything. All bad stuff also mind will remember. I don't want the mind to apply. You apply your skill. Tell me. Assuming the company pays a dividend. Company pays what's a dividend. And has a net profits of 5 lakh. Okay, net profit 5 lakh. Makes a new investment of 10 lakh. During the period, calculate number of new shares to be issued. Use model. Okay, this is the question he asked. First, how much net profit is there? 5 lakh. Company pay dividend or don't pay dividend? Pay dividend. How much it pay? It pays a dividend of how many shares are there? So totally rupees 10 lakhs of 100 rupees each. So 10 lakh divided by 100 means how many shares are there? 10,000 shares are there. 10,000 into 10, 1 lakh dividend is paid. Okay. Now listen carefully to the point. He is asking us a question. Do when dividend is declared. I will do for both. This itself, please don't do with me. I will first do the answer. I will later give time for you to copy. Please see the screen everyone. Step 1. Dividend not declared. He didn't ask in the question, but still I am doing for your client clarity on the concept. Dividend not declared. Please. First lesson later you can do. Okay na? Okay. See here now. Dividend not declared. First, what is the P naught rupees? Sorry, P1. Sorry. I'm very sorry. What is the P1? Rupees 112. Rupees 112. Okay. Step number 2. Amount to be raised. Amount to be raised. MP1 equal to I minus E minus ND1. MP1. P1 we know. Okay. 112. P1 equal to, sorry. Very sorry. P1 is 112. M number of shares, how many to issue we don't know. 112 M equal to, how much is the investment opportunity available? 10 lakh minus, how much earning is there? 5 lakh. If you don't declare dividend, how much it will be? 0. So 112 M equal to 10 lakhs minus 5 lakhs. So 112 M equal to 5 lakhs. M equal to 5 lakh divided by 112. How many shares? 4464 shares you have to issue. 4464 shares you have to issue. Okay. This is the step number 2. Step 3. Price of the share or wealth of the company today. Wealth of the company today. Formula. Everyone in the class. NP not equal to ND1 plus NP1 minus I plus E whole divided by 1 plus K. Now you know the logic as well. Even in the examination hall, if you forget the formula, go by the concept. Okay, take D1 plus P1 divided by 1 plus KE. P not equal to N multiply by N on LHS multiply by N on RHS minus MP1 plus MP1. MP1 equal to, already you know this formula. Apply, you will get the formula. This is what I want to talk about. Concept discussion. Okay, concept discussion. We are not going to do any problems here. We are not doing anything mechanically. Okay, so that equal to ND1. N means number of shares before. How many shares are there? 10,000 into D1. What does it mean ND1? Dividend will be declared before public issue. Means I will not issue dividend to the newly issued shares. So old shares only will get the dividend. 0. I am not paying any dividend. We are not paying any dividend. If dividend is not declared, D1 will be 0 plus NP1. NP1 means what? N means 10,000 shares into 112 minus how much is the investment opportunity available? 10 lakh plus how much is the earnings available? 5 lakh whole divided by 1.12. So everyone take calculator. 10,000 into 112, 11 lakh 20,000 minus 10 lakh plus 5 lakh whole divided by 1.12. 11 lakh 20,000 minus 10 lakh plus 5 lakh whole divided by 1.12. Okay, some worth of wealth will come now. So if you observe clearly, if I don't declare a dividend, if you observe clearly, an amount of wealth will come. Put it aside. I am not doing any answer here. N means number of shares. Okay, see here, from these I have taken this. Okay, this we have taken. You can use this formula as well now. See here, same answer you will get in both the cases. NP not equal to P1 into N plus M minus I plus E whole divided by 1 plus KE. Use this formula also. Keep that answer aside. Someone is giving the answer 55357. That's a wealth, normal wealth. So use this formula now. P1 is how much? 112. This is a direct formula. P1 112. Okay. N, how many shares are there with us? 10,000 plus M, how many new shares you have to issue? 4464 minus how much is the investment? 10 lakh plus 5 lakh whole divided by 1.12. So instead of before, we will use after also now. 10,000 plus 4464 into 112 minus 10 lakh plus 5 lakh whole divided by 1.12. It came to rupees 10 lakhs. Everyone, have you got the answer or not? Everyone, have you got the answer? 55357, what is the meaning? I will tell you in the next topic. Next topic, meaning also I will tell you for what is that previous one, 553571. But before that, everyone understood the 10 lakh concept or not? A small rounded off error will come here. 9,99,970, like that we will get the answer. Round it off to 10 lakh. Round it to 10 lakh. It is because of fractions. Because we didn't take 4,464 point, we didn't take na. That's why fractional change will come. So this is before declaring dividend. In question he didn't ask this. So we are now doing after dividend. Everyone please listen carefully. Step number 1. Step number 1 will be talking about first point. P1 equal to rupees 102. Already done. Step number 2. MP1 equal to I minus E minus ND1. So, we know the P1 value. Okay, we know the P1 value. 102 M equal to investment is 10 lakh minus earnings is 5 lakh. Very important. Minus number of shares before public issue 10,000 into what is the dividend declared at the end of the year? 10 rupees. 102 M equal to 10 lakhs minus 5 lakhs minus 1 lakh whole divided, sorry, put it like this. 102 M equal to 10 lakhs minus 4 lakhs. M equal to 6 lakhs divided by 102. 5882 shares we need to issue. 5882 shares we need to issue. 5882 shares we need to issue. Okay. Next. NP not equal to P1. Directly use this formula. P1 into M plus N plus M minus I plus E whole divided by 1 plus KE. P1 is how much? P1 is 102. N 10,000. M 5882 minus 10 lakh plus earnings 5 lakh whole divided by, sir, I am asking earnings. I am not asking E minus ND1. Overall earnings, total earnings 5 lakh whole divided by 1.12. Whole divided by 1.12. Sir, why, sir? You are here taking 5 lakh, sir. Why not 4 lakh, sir? A concept will arise or not? Because I have common sense, sir. Okay, what common sense? We are calculating NP naught, means today's value. Today we didn't declare dividend. We declared dividend after 1 year. So today's wealth we are calculating. Okay, today we didn't declare dividend. Then how you can write 4 lakhs here? It is 5 lakhs only. Clear, everyone? So 10,000 plus 5882 into 102. 16 lakh 20,000 minus 10 lakh plus 5 lakh whole divided by 1.12. 16 lakh 20,000 minus 10 lakh plus 5 lakh whole divided by 1.12. Wealth again stands at 10 lakh. So, whether you may not declare dividend, whether you declare dividend, wealth will not change because you are having I. Why I is important here? I is investment. Okay. If you are having investment opportunities available with you, whether you declare dividend, whether you don't declare dividend, your wealth will not change. Share price may change. 112 may become 102, no problem, but the wealth will remain same. Okay, wealth will remain same. You may have more than that, you may have less than that. 112 may become 102 only. Share price will change, but the wealth will not change. Overall wealth will be maintained if you are having an investment opportunity. Hope everyone understood the concept up to here clearly. Everyone. Hope everyone understood the concept clearly. Yes or no, everyone should participate. Everyone understood? Okay. Now we have completed Modigliani Miller as a concept. Okay. So last final touch. Okay. Last final touch I will give and I will go to the next concept. So the doubt everyone will get is, sir, share price from 112 fall to 102. There is a fall in share price. But you are telling that wealth doesn't change. Sir, I didn't understand the difference between fall in share price and wealth maintenance. What is the difference between wealth and market price? That also you should understand or not. That I will explain. So from the company point of view, this is the answer. Okay. From the wealth of a shareholder point of view, let us see. I will take our previous example. Take this example. See here. Okay. Now listen carefully. I am taking a different example altogether to explain this particular concept. Okay. See here now. My point of view is wealth. Wealth is different, price is different. I will explain you. Say for example, you are holding all the 1000 shares in this company. Entire 1000 shares you are only holding. Understand like that for the time being. All the entire 1000 shares you are only holding. So now what will happen if you hold the entire 1000 shares? Your wealth will be before dividend. Before dividend. Your wealth is 1000. Your wealth is how much, sir? 1000. 1000 shares into 10 rupees each. As a wealth it is 10,000. As a wealth it is 10,000. Okay. Dividend not declared. Dividend not declared. What will happen? Same 10,000 will be maintained. Now after dividend, what will happen? Let us see. After dividend. After dividend, you are only holding all the 1000 shares now. You only subscribed for the extra shares required for public issue. This 111 shares. You only purchased. So 1 into 9. Your wealth again stands at same 10,000. Means price from price from 10 has fall to 9. No, I am not denying that. Price has fall. From 10 it has become 9. No doubt in that. However, number of shares also increased. Because of that, wealth has been maintained. Hope everyone understood the concept clearly. This is called as maintaining the wealth. Reply everyone. Hope you understood the concept of Modigliani Miller in a right sense. We completed now. Any problem, let it come in examination. Those who are listening to the session today, you will answer any kind of question that comes in examination. Tadhastu. It will happen. Any question can come in examination. You will be in a position to write. Clear everyone? Understood? Okay. Next one. Walter model. Don't see Walter model just like a, okay. Don't see Walter model just like a formula. There is a lot of there is a lot of understanding inside the formula that we are going to concentrate in the today's class. Okay, we are going to concentrate not just on the Walter model per se. We are going to understand the science behind it. Okay, so what philosophy this Walter model want to convey to the public, that we are going to understand. Please everyone, don't drop your patience level. How active I am at the beginning till the end, you should also be same level active. I want every one of you to be active in the class. Please. Formula for Walter model is price equal to D plus R by KE into E minus D whole divided by KE. Okay? Whole divided by KE. Okay, now listen. These models, Walter, Gordon, Linters, all these models says that dividend will necessarily impact the share price. If you declare dividend, one price will come. If you don't declare, another price will come. I repeat, if you declare, one price will come. If you don't declare, another price will come. This is the philosophy of all the models. Modigliani Miller says that whether you declare dividend, whether you don't declare dividend, answer will not change. Is the philosophy of Modigliani Miller. He also proved this. And I can tell you in another way. What is the formula here? P1 into N plus M minus I plus E whole divided by 1 plus KE. Is the formula for the wealth under Modigliani Miller model or not? Yes. In that, where is D1? Where is D? My formula doesn't have D inside. Means what? Dividend has no impact on the wealth. Game over. Simple words we can tell this. When the formula don't have D1 or D, then how can you tell that it is going to impact your shares? It is impacting your wealth. No. So therefore, in one word we can conclude using the formula itself, it is a dividend irrelevance theory. Formula of Walter starting a D means dividend is necessarily impacting the price. If D you remove, one answer will come. If you put to D, another answer will come. Means what? D is having necessarily an impact. Okay? Now listen. Before we go into the next concept of Walter, before that, tell me how many kinds of cash flow streams are there? Time value of money concept. How many types of cash flow streams are there? I want an answer. How many types of cash flow streams are there? Okay. Sir, everyone is giving their own answer now. I will show you. See here. Cash flow streams, I am asking that question. See here. Whatever I have explained you was already kept in the form of this document. Okay. See here. Walter model P naught equal to D plus R by KE into E minus D whole divided by KE. Okay. Gordon's model P naught equal to D1 by KE minus G. Two things I said there. First, let me put out what are the various types of cash flows. Please everyone see the screen properly. Yes. See here. I will make it very fast. Look here. This concept helps you to drive in a right direction before you start doing any chapter in FM. This is all CA final notes, but basics na, even in CA final I start from bare basics. As if inter student is sitting and listening, na, in that way only the class starts. For the first 5 days, 5 into 2.5, almost around 12.5 to 13 hours. Impact of dividend, everything, basics of CA inter A I will teach for 15 full hours. After that we will go into CA final syllabus. Okay, because they also are not so great. Without any basic at IPCC or CA inter, they fall to final. At that time they will break their head and brain, how this formula came, what is this concept going on. So therefore let us understand. Time value of money says that there are two types of concepts: discounting of cash flows, compounding of cash flows. Discounting is a concept of bringing the future to present. Compounding is a concept of taking the present to future. Okay, taking present to future. Whenever you are making a deposit with a bank, we use compounding methods, because your deposit you make, okay, how much today's money will multiply to future, we will calculate. But estimates are there, na, we will always use discounting. That's why PV factor is a discounting factor in all our cases. See what is a discounting concept. Future cash flows are there. The concept of bringing the future to present is called as a discounting. The concept of bringing the future to present is called as a discounting. How we can bring the future to present? Using a factor called as a PV factor. This is a PV. I don't want to discuss about this. Listen. There are 4 kinds of cash flows. Everyone has answered 3, 2, etc. One person might have answered 4, but I don't know whether he know or not. If you know, na, fantastic. There are 4 kinds of cash flows, streams of cash flows: single cash flow, multiple uneven cash flow, annuity even cash flows, perpetual cash flows. I will explain one by one very clearly. Single cash flow: I will not get any inflow this year, I will not get any inflow next year. I will invest today, I will get only one inflow, that too after 10 years or 20 years or somewhere I will get. That's called as a single cash flow. Example, zero coupon bonds. Zero coupon bonds means what? I will invest today at 5,000. I will get 25,000 after 10 years. Like that they will tell. In the medium term, in the middle, what I will get? 0 you will get, nothing you will get. Okay. So next, multiple uneven. Capital budgeting problems will come under the second category. When you purchase a plant and machinery, every year cash flows will change. Every year same cash flow will come. Machinery will give same revenue, may change or not. Multiple uneven. First year I will get 1 lakh, second year I will get 2 lakh, third year I will get 1 lakh 50. Like that it changes. Multiple uneven. Annuity. Okay, annuity. Annuity means what? Multiple cash flows will come, but even cash flows will come. 100, 100, 100, 100, like that I will get. Example, debentures interest. Debentures interest. First example, zero coupon bonds. Second, plant and machineries and capital budgeting. Annuity, I said already, debentures, deposits, etc. First one I can give another example, life insurance policy. Whenever you take a life insurance policy, you will pay, but you will get the cash flow only after 25 years or 30 years. It's a single cash flow. Only one cash flow they will give. Okay. Last one is very, very important. Perpetual cash flow. Sir, why I am discussing about perpetual cash flow? I am not a damn bloody fool unnecessarily to discuss about cash flow streams. Walter model depends on perpetual model. Walter theory depends on perpetual model. Okay. So don't unnecessarily think that I am a damn bloody fool unnecessarily discussing about these concepts. No. You have to understand how the Walter model has come. So therefore, listen carefully. There are 4 kinds of cash flows: single cash flow, annuity cash flow, multiple uneven cash flow, perpetual cash flow. How many cash flows are there totally? 4 different kinds of cash flows are there. So now I am going to explain that 4th one very clearly in detail. Okay, please everyone listen carefully. A little amount of patience. Okay, when you are not learning a concept or not knowing a concept, a little amount of patience. See here, this is the formula. P naught equal to D plus R by KE into E minus D whole divided by KE. D plus R by KE into E minus D whole divided by KE. Sir, R by KE, what is this going on, sir? I couldn't understand the formula clearly. Listen. I will take a separate document. See here. This is the formula here. Philosophy of Walter model, let us understand. There are two parts in the formula. How many parts, sir? Two parts. Two parts are there in the formula. Price of a share depends on two things. D by KE, R by KE into E minus D whole divided by KE. That's a common LCM, na? So, two parts are there. Part 1, Part 2. Part 1, D by KE, R by KE into E minus D whole divided by KE. Sir, what is this by KE? First explain that. I will come to that point. I am coming to that. Listen. Present value of perpetual cash flows. If I invest in a land and building, life of 10, 15 years or 30 years or 40 years or 50 years or 60 years or is there. Plant and machinery na 6 years or 10 years or will be there. So perpetual cash flows will not come. Definite number of life will be there. 10 years or 7 years or some life will be there. Okay. So, but the problem will come only in case of, share, because life is perpetual. We can't tell definitely this is the life of a share. Then how many years I will take? Year 1, 2, 3, 4, 5, 6. How many years I have to take? I have to go on doing that calculation, which is not possible. As per Contract Act, we call it as supervening impossibility. We don't know where it ends. Then what I can do? I have to do something now. So therefore, present value of perpetual cash flows equal to, listen, cash flows per annum divided by required rate. Cash flows per annum divided by required rate is a formula. Sir, how this formula came? That I am going to discuss now. See here. Listen carefully. Everyone please, concurrent viewers, whoever is watching the lecture, I should not see anyone leaving. I want participation. Clear? Listen carefully. I will give you two options. Option number 1. I will give you 1 lakh forever till you live is option 1 given. Second option given. Ask some bulk amount today itself. Okay? Repetition of the question once again. I said to you, I will give you 1 lakh forever till you live. If you die, I will give to your next generations. Okay, 1 lakh every year I will give. Do you want that? Or for that 1 lakh in future, pay a bulk amount today itself. Say you are required return 10% or some amount is required. Okay, you require 10% return. Don't apply formula here, please. Don't take calculator and calculate. I am asking you, you expect some return of 10% here. Okay, generally you are expecting 10%. You are an investor who expect 10% to come. That's all. Okay. Now, I will give you two options. Do you go for 1 lakh forever? You will go for a bulk amount today now. Generally, people will ask bulk amount only because, sir, you will be paying 1 lakh, but there is a chance that in future anything can happen. I may die, legacy may stop, or you may die. Anything can happen. Na? So therefore, automatically what people will tell, sir, I don't want 1 lakh forever, sir. I want bulk amount. Some people may think that, sir, bulk amount I don't want. I want 1 lakh forever, sir. 1 year la 1 lakh means I can use it for some expense. Like the two kinds of persons will be there. Okay. Like that two kinds of persons will be there. So, you will go by what? Bulk every year. Tell me. Bulk or every year? Okay, some are asking every year, some are asking a bulk amount. Sorry, okay, now last one last question, everyone in the class, one last question for you. My question is, you are asking bulk amount, some are asking every year. Okay, so I will ask you one question. Bulk amount, how much you want? 1 lakh forever, till your family live, next generation live. 1 lakh I will pay like that forever. For that, ask a bulk amount today. How much you will ask? Bulk, I will give you bulk today itself. If I give bulk now, I will not again give 1 lakh forever to you. How much you will ask? I am not joking. Really, answer my question. How much you will ask? One person 10 crore he will ask. One person 1 crore. Arey, Dharmendra Singh Rajpurohit, I am not asking you the FM concept. Ask as a normal person. One person 106 billion. Some person 1 lakh crores. I can give, but you should remember, I am Mukesh, not Mukesh Ambani. Okay, so you can ask anything. इतना है उतना दे दो मीन्स मेरे पास कोई नहीं है. यस, पूरा खाली. माना अपनी जेब से फकीर है, फिर भी यारो दिल से हम अमीर है. धर्मेंद्र सिंह राजपुरोहित, I think you can understand what I said. Okay, so that way you can ask any amount. So now the question will arise, how much to ask? See here, I will pay you 1 lakh forever. Okay, 1 lakh forever. Ask a bulk amount today. Some people are asking 1 lakh, some people are asking 10 crore, 100 crore like that. I will give you 10 lakhs only. Bulk I will give you 10 lakhs. Okay, so bulk I will give you only 10 lakhs. I will not give you not even a single rupee beyond that. Sir, what 10 lakhs, sir? 10 lakh means 1 lakh a best, sir. No, 1 lakh forever and 10 lakh bulk, both are same. I will prove you now. I said, your expected return is 10%. Your expected return is 10%. People may not believe, sir, I will live at least for another 50 years, na, sir. 50 into 1 lakh will become 50 lakhs, sir. How, sir, you are paying only 10 lakhs to me. Listen, you live for another 50 years, sir. Take for example, you live for another 50 years. 50 years after 1 lakh will come. 50 years after 1 lakh will come. Okay, so 50 years after there will be a discounting factor. Everyone take calculator. My required return is 10%. 1 by 1.10. Take 50 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47, 48, 49, 50. This into 1 lakh, 851 rupees it is. 851 rupees it is. Don't see the future value. I want present value of that 50 years after 1 lakh. Today's value is 851.85 rupees. Okay. Don't misinterpret financial management as a subject. 1 lakh is the value I will give you after 1 year, after 2 years, after 10 years, after 20 years, after 50 years, after 80 years. Are 50 years after, if it is 851, after 80 years it will be somewhere around 10 rupees or 5 rupees. Don't see it as 1 lakh. Are 50 years after 1 lakh means at that time 1 lakh today, at that time it will have a value of 850 rupees. Hope everyone understood. Everyone, I want a reply. Everyone understood what I said now. Everyone, reply. Okay. So, how to interpret this? It is only 10 lakhs. 1 lakh forever. Bulk amount today, it is only 10 lakhs. Okay. So, how you can prove this? See here. What I have done is, per annum I will give you 1 lakh. Divided by my required rate is 10%. Take calculator. 1 lakh divided by 10% equal to how much? 10 lakhs. This is how the amount came. But what is the proof that this is correct? Okay. I will prove that also. See here. I will give you bulk amount of how much? I will give you a bulk amount of 10 lakhs. I will give you a bulk amount of how much, sir? 10 lakhs. You take that 10 lakh to a bank. Your expected return is 10%. Wherever, whichever bank give you 10%, deposit there. So you took 10 lakh rupees, deposited in a bank which gives you 10%. Every year how much you will get? 1 lakh. That's what I said. So 1 lakh you will get if you invest 10 lakhs. Sir, then better sir, I will have 10 lakhs, I will also have 1 lakh. No, you will get only 1 lakh if you put 10 lakh deposit. If you withdraw 10 lakh, 1 year 1 lakh will stop. Means 1 lakh forever. Bulk value today is 10 lakhs. Hope understood everyone in the class what logic I said now. Okay, so some people may think, no sir, bulk amount is better sir, because if I have bulk I will invest in bank. 10 lakhs is with me. No, 10 lakhs is not with you. You can't use that 10 lakhs. It is with the bank. Bank will give you 10% return. 1 lakh only you can use. Okay, 1 lakh only you will get. So every year bank will give you 1 lakh because of investing the 10 lakhs. You withdraw that 10 lakhs immediately 1 lakh will stop. Okay, so therefore 10 lakhs is equal to 1 lakh forever every year divided by 10. Means what is the formula? Present value of perpetual cash flow equal to cash flow per annum divided by R. Means 1 lakh divided by 10%. Now listen carefully. Company will pay dividend 1 year every year. I mean dividend is a perpetual dividend, 1 year dividend perpetual. Means put cash flow per annum instead of this, put D divided by R. What is the required return on equity share? KE ya, KD ya, KO na? KE. This is how D by KE, the first part of the formula has come. Hope everyone understood. Okay, so that's how D by KE has come. Always remember in brain. Always, everyone listening to the session, remember in brain. Always till we die. Remember one thing in financial management. Divided by 1 plus KE, divided by KE came na. It is called as perpetual discounting. Every year, perpetual. Those are called as perpetual discounting factor. Divided by KE means. Okay, so this is the answer for the given question. Okay, now first part over. Okay, so the price of the share depends on the dividends perpetually you are going to pay. Okay, second part, R by KE into E minus D whole divided by KE. This is complicated. Sir, listen carefully. In next 10 minutes we will close this. So please, everyone, concentrate properly. R by KE into E minus D whole divided by KE. Let us understand the science behind this. Okay, see here. I have earnings of 10 rupees per share. I have earnings of how much, sir? 10 rupees per share. Every year it will come. Same, constantly I will get that. From that, I will pay 4 rupees as dividend. Every year, 4 rupees as dividend. How much is the retained earnings? 6 rupees. Okay, 6 rupees is the retained earnings. This 6 rupee I will put it in the dustbin. I will invest somewhere. This I will invest somewhere which will give me R% return. 10 no, 12 no, 20 no, 15 no, 18 no, some percent, R% return. Okay, return percent is R. Okay, R% I am giving I am investing the 6 rupees. Okay, when you will withdraw, I will not withdraw. It's a perpetual deposit or it's a perpetual investment. Means I am investing 6 rupees. Okay, at how much rate? R rate. Okay, at how much rate, sir? R rate, which will give me return every year. Means like example I said to you, 6 rupees is there. I will invest at 20% return. Means 1.2, 1.2, 1.2, 1.2 forever it will give. What is the present value for that? 6 into R cash flow per annum divided by KE. Divided by what, sir? KE. 6 is what? 6 is nothing but retained earnings. What is retained earnings? E minus D. Means E minus D into R. Okay. Whole divided by KE. This is another one part of the numerator. Okay. R into E minus D whole divided by KE. Understood this part or not? Everyone, tell me. Understood or not, everyone? Okay. Okay. Now, what is the concept you need to understand? This is for 1 year. This is for 1 year. This year, okay, thank you, sir, everyone. Listen carefully, last part. This year, 1 year, this year, I got a earnings of 10. I paid a dividend of 4. I got a retained earnings of 6. This year, 6 rupees, I will reinvest. Reinvest at R rate. That reinvestment will give cash flow for how many years? Perpetual years. Therefore, what is the present value of that return? 6 into R. 6 is called as E minus D into R whole divided by K. This is for 1 year. Like this, it happens for how many years? Perpetual years. Therefore, E minus D or R into E minus D whole divided by K. This is for 1 year. Like this, it happens for how many years? Perpetual years divided by K. That's how the formula has been derived. Hope everyone understood the Walter model properly now. Everyone understood the Walter model properly? Okay? Yes. So listen carefully. As per the intention of the classes, I will be putting continuous classes only whenever time permit. So I am not going to do problems and waste your time again in the class. I want to put focus on understanding part. Once you understand, and now after the class people will do just like that the concept. Walter model one part is still balance is there. Next tomorrow's session I will continue that and I will complete garden and linter. Once after that I will go into the cost of capital area. Cost of capital also will complete it. Okay, there also KD, KO, market value weights concept is that I want to focus on. So that also I will discuss very clearly in detail. First, very important thing, session is useful for you or not? Honestly, I want an answer. First point, everyone. Session is really useful for you or not? Is it a time waste for you or is it useful for you? Thank you very much. Thank you very much. Overwhelmed with the response. So I say you very, very clearly again and again, than law, financial management will have more concepts to discuss. Okay, so therefore, please, once you understand the essence of the concept, easily you can solve the problems just like that. So next session, tomorrow's session, we will be taking up continuity to this, and we are going to complete the entire concept of dividends, and next I will come to the cost of capital concept. Okay, concept discussion will take time, so problems will not really take time. Okay, so therefore I am closing the session for here. And next session la we will continue with Walter model. Last area is there that I will cover, and we will do problem also on garden model. We will do linter model also. We will do 1 hour. We can complete all those. Next we will go into the concept called as cost of capital, KD, KO, KD, KE, KO and KP. 4 concepts I will explain first. After that, 1 problem in each area. Later we go into the market value weights and try to solve the problems. With that, everything will be completed in this area. Clear, everyone? So thank you very much for your patience, and thank you very much for your response that you have given. And please also share this video. The only request from my side is share this video till it reach maximum people. Okay, our voice and our clarity should reach each and every CA inter student. That's the only intention. Let not only some persons get the benefit, let everyone get the benefit. My only wish, my only request from my side, please share it to the maximum. Let everyone know what really the intention of Modiklani Miller, and more videos to come. I will support you till you go to the examination. That's a guarantee I can give. Okay. So thank you very much. Have a nice sleep. Everyone, good night. Sweet dreams. Love you all. And we will be meeting in the next session with a continuity to the Walter model. Thank you very much. Bye. Good night.